Policymakers at the U.S. Federal Reserve have thrown investors for a loop. Many who work in the markets expected the people at the Fed would decide to start retreating from their stimulus campaign. But policymakers surprised them when they announced they would stick with their strategy of easy money. Chairman Ben Bernanke said the economy is growing at a moderate pace. He pointed to rises in household spending and business investment. But he said the job market still lacks steam.
In evaluating whether a modest reduction in the pace of asset purchases would be appropriate at this meeting, however, the committee concluded that the economic data do not yet provide sufficient confirmation of its baseline outlook to warrant such a reduction.
Fed officials noted that an uncertain outlook on the debate over the U.S. budget is holding back economic growth, and prices for goods and services are below targets. So the central bank will keep buying $85 billion worth of Treasury bonds and mortgage-backed securities every month. Bernanke said policymakers could start tapering bond purchases later this year if they can confirm more signs of sustained improvement. They said they'll keep the key interest rate near zero as long as the jobless rate stays above 6.5%. The most recent data puts it at 7.3%. For analysis, we spoke to Louis Alexander, chief economist in the U.S. for Nomura in New York.
The decision today was quite a bit of a surprise. So I think markets had been prepared for the Fed to slow its pace of asset purchases, and when they didn't do that, I think that has led to a pretty strong rally across pretty much all markets. The equity market is up sharply, bond prices are up sharply, so rates have come down, and you've seen sort of generally risk assets do well, and that includes, importantly, emerging market currencies. So I think this was a surprise for markets, and they're responding in a fairly strong way. Now, what this implies for what the Fed's next move is, Bernanke stressed that the framework for policy that he has laid out over the summer is still in place, but he definitely expressed some greater doubt as to the timing. I think it's our judgment that it's probably now likely that you'll get the tapering in December. But there's more uncertainty about that than I might have thought. The other thing that the Fed did that was important is they lowered their forecast for 2014. I think this primarily reflects the rise in interest rates we've seen since May. I think it also reflects some increased concerns about risks on the fiscal side. And we're going to have to see how those things play out. Now, I think with respect to currencies in particular, what I think you're seeing now is a sort of reversal of some of the things you saw with this speculation about them tapering. So most notably, I think emerging market currencies are doing much better. The yen, I think, is also doing much better. I think this is seen as a good risk environment for Japanese assets. We're getting a kind of generic risk-on kind of reaction, and that does have implications across many, many markets.